Okay, we'll get started now. For those of you who may not know me, I'm Jay Taylor, and I've been around these parts for many decades. First came up to Vancouver back in the early 80s when there weren't very many tall buildings here, so I'm giving you a little bit of my age. I'm one of the senior citizens here, that's for sure. Anyway, good to be here with you. I want to talk today about the credit cycle and where I think we're at in the credit cycle. Just like to advertise my radio show. I have a radio show every Tuesday. It airs at 12 noon Pacific time. You can listen to it live at the Voice America Business Channel, or you can listen to it the following day as a podcast at jtaylormedia.com. And my guest this week, Ronald Peter Stoffel. He's the managing partner and fund manager of Incremental AG. Many of you know him for an annual report he puts out on gold called In Gold We Trust. Amir Adnani, many of you know him, and technical analyst Michael Oliver is my guest every week, almost every week, because I have so much confidence in his technical analysis that really sort of calms me down when the markets aren't going the way I want them to go. So I want to talk about the markets and geopolitical forces that work this year. I've sort of talked about this the other couple of times I've been here. We're in the late stage of a credit cycle that began after the collapse in 2008, 2009. Generally speaking, this is a good time for commodities. It's not a very good time for government debt, for debt in general, because rates start to rise. It's not generally good for equities, and I believe we're getting very close to a major decline in the U.S. equity markets. Most of the equity markets around the world have not done well recently. The United States equities are the last ones to stay up there. But I would argue that this is not a normal credit cycle. This is something much bigger and potentially much bigger than the last collapse that we had. The problem is we keep piling more debt on top of debt. Every credit cycle is never allowed to wash out. The pain is relieved temporarily by pumping more money in, creating more debt, but never allowing the market to reach equilibrium. So we have the third factor that I think is really big, the one I think that very few people are paying much attention to, are growing geopolitical tensions that I think could and are likely to, it's a matter of timing, threaten the U.S. dollar, and I'll talk about that in a few minutes. So what happens in the late stages of a credit cycle is that you have lending. Banks start to lend a lot. There's a reason for that. The banks hold treasuries at the bottom of the cycle, and as rates start to rise, they have to get rid of their treasuries or they'll lose money. They then use that, and they at the same time start losing their fear of the business cycle. They believe they can lend money safely, and they're not as fearful as they were at the bottom. So lending starts to take off, and you can see here from this chart that the peak of these lending cycles tend to happen at or around the time of a recession. And I think we're getting very near that now. We've had the most tepid growth, economic growth that we've had in a long time. As a matter of fact, the red line shows what this cycle is like in terms of real GDP compared to the normal, which is the blue line. But true to form, we have seen a rise from the bottom at least. Here's the Goldman Sachs Commodity Index. It's up 57% since, well, this is since 2016. The late part of the cycle is when commodities do better. Wage growth, tepid like the recovery, but there has been some wage growth now. Producer prices, they also start to peak out during this period of time. So we're seeing producer prices will start to threaten, theoretically at least should start to threaten earnings for corporations. Again, I say this isn't your father's credit cycle because we see the debt line or the blue line relative to GDP. And we saw a little flattening out after the recession, but true to Keynesian economic theory, the Federal Reserves and all the banks around the world pumped huge amounts of money into the system, and off we go, and we our narcotic, our monetary narcotic, relieves the pain, and it has done so now for about 10 years. So pretty long business growth period, even though it's tepid. What is really alarming from a U.S. budget, federal budget perspective is that a 1% rise now in interest rates adds $212 billion a year to the federal deficit, to the financing needs of the government. That compares to $3.7 billion in 1970 when we were still on a gold standard. Now, here's the 10-year Treasuries. Yes, they're rising, and a little over 3% on the 10-year. But, you know, that red line shows sort of what was always the bottom before. Can we get above 4% without causing trouble? So far, the equity market is hanging in there, and the business, we seem to have GDP growth yet. So, but most of the people I talk to, like David Stockman on my radio show, who was Ronald Reagan's budget director, several other people that I have on my show on a regular basis are very skeptical that we can go much higher in interest rates before the credit system breaks down. An interesting statistic I learned about just the other day, the New York Fed has a favorite inflation measure that they used to publish, but they said they're not going to do it any longer. It's about 1% higher than the CPI. I'm not sure why the Fed decided not to print it. I don't know, but I have my suspicions. One of the reasons that they've been able to print so much money and the inflation rate stays low, that is the CPI, the inflation rate that the government recognizes for payments of Social Security and so forth, is that the velocity, the monetary velocity has been very low. So money goes in the system, but it isn't spent. It doesn't get out into the system. It's starting to a little bit because banks are starting to lend now. But if the velocity takes off and people start to fear inflation, the normal response is to go out and buy stuff today because tomorrow it's going to be more expensive. So if that psychology changes, and I would suggest that may be one of the reasons that the New York Fed doesn't really want to advertise its favorite inflation indicator. And of course, another way that they've kept inflation down is simply by the money has flowed into the financial assets. So we have a financial asset bubble. I would argue that rivals what we had in before the crash of the last cycle. Rates, again, rates rise. This is what happens in the last cycle, towards the end of the cycle. Rates rise as borrowers demand money. Banks sell treasuries, and treasuries lose money, and banks lose money if they hang on to them, so they sell, they finance, they make loans, and commodity prices tend to rise, wages and CPI tends to rise, and then central banks become alarmed. I think they have been trying to normalize the balance sheet that the Fed has, and in anticipation of the next cycle, it wants some dry powder to be able to lower rates again. So in any event, they're in the process of, right now, they're in the process of raising rates, and the current Fed chairman seems to be hell-bent on doing so. So we'll see where it goes. The flattening of the yield curve is almost always evidence of the end of the cycle, and we're getting there. It's not inverted. Sometimes it's inverted before the system collapses, but we're getting very close. This looks very much like many of the other cycle-ending yield curves. And as far as the equity markets go, this is a chart I just saw last week. The last time that bonds were this attractive relative to stocks, the recession started. But you know, people like me that say things like that, this is what we're told. Just shut up, you moron. Do as you've been told. It's for your own good. Of course, Wall Street has its reasons to keep selling stocks, right? Doesn't want you to get depressed. So where will the U.S. Treasury funding come from at these low rates? And again, with growing geopolitical strife that I think is a very real concern. With the Chinese and the Russians want to keep buying treasuries when we use those financings to support a military that defies their ambitions. How high do rates have to go before the system breaks down? Some people think 4% is getting close to it, and how much higher before the next credit crisis? These are the questions in my mind. As for geopolitics, when Obama was pushing through the Iranian nuclear deal, the neocons, the neoconservatives, were pushing back against Obama, and of course now they've gotten Trump to reverse it, the agreement. But Secretary of State Kerry warned that we could really have it could be a real threat to the dollar hegemony. And he said, if you're going to tell the Europeans that you're going to slap sanctions back on the Europeans when they already did what they didn't want to do because the United States they muscled them into implementing sanctions, and we get this agreement, and now you're going to walk away from that agreement, that, my friends, he said, is a surefire way to destroy the dollar's reserve currency status. That was his remark, and I played it several times on my radio show because I thought it was so insightful and so impressive. Now, this morning I happened to wake up after sleeping off the effects of too many glasses of wine last night, and I came across this news article. It seems as though that the United States, it seems as though this growing rift against the United States empire is something that we don't hear much about, of course, for obvious reasons, but it seems to really be going on. The Europeans are really ticked off about trying to force them to put sanctions back in place. So they've joined with Russia, China, and Iran to find ways to scoot around the tariffs that the U.S., the sanctions that the U.S. is putting in place, and tariffs as well, no doubt. Actually, this started before now because the Chinese and the Russians, when Obama threatened the Russians with sanctions, and actually put in sanctions, and then threatened to take away their SWIFT trading capability to move money around the world, the Russians and the Chinese started to work on an alternative to the SWIFT system. And they also started to plan a gold-backed trading system, a gold-backed yuan, if you will. And so now we have the Shanghai Free Trade Zone in which the mechanism is set up, and in fact, it is starting to happen from what I understand. Oil is being sold not for dollars, because that's what made the dollar possible also, was to force nations to pay for their oil purchases in dollars. So the Russians and the Chinese aren't too keen about that. Needless to say, neither are the Iranians. So they set up this free trade zone which allows Russia, or whoever wants to sell their oil to China in exchange for yuan, and then they can take their yuan over to the free trade zone and exchange it for gold. So that is in place now. The Chinese have been building up huge amounts of gold. As the paper markets have plummeted the gold price, the Chinese have been buying and importing gold like mad. They are the largest gold miners in the world. So between their gold production, domestic gold production, and imports, there's a chart showing how much the Chinese have acquired gold. They've just been acquiring it like crazy. And of course the Indian people have always been known for their love of gold. So between the two, it's a massive amount of gold that's been flowing from the west to the east, to those two highly populous countries. Russia too has built its gold reserves very dramatically. Part of the axis of evil that the United States like to talk about. And now India, for the first time, the Bank of India has purchased gold, first time in 10 years, has been purchasing gold. The U.S. has long depended on the kindness of strangers, we say, because we didn't want to buy our own treasuries, but other countries would do so. But that seems to be grinding to a halt. Russia, in fact, has now sold all their treasuries. They don't own any U.S. treasuries anymore. So the big question is, how is this going to be financed? I suspect that the Fed will keep the monetary situation tight until the system breaks down, and then we go through it once again. The only thing that central banks know to do is to do what they've done in the past. But the U.S. can do that only so long as people are willing to accept, as long as the confidence in the dollar is there. And if foreigners no longer want dollars, then I think the day of dollar hegemony is probably nearing its end. Regarding the commodity prices, you know, we always think in terms of dollars for obvious reasons, but clearly it's not, I think that's the wrong question. What we need to think about is how low will the dollar go, not, you know, how high will commodities go relative to the dollar. The dollar is not something, a stable yardstick that you can use to measure things against. Gold is. Gold has risen dramatically since Nixon took us off the gold standard, but is that because gold has gained so much value? No, it hasn't. It's the same thing as it was back in 1971. It's because the dollar is declining in value dramatically over time. Now, with regard to, I mentioned that commodities have, in the late stages of a cycle, the credit cycle, commodities do better, but still relative to equities. This is a Goldman Sachs chart that shows where commodities, their Goldman Sachs commodity index is relative to the S&P 500. This was just taken a few days ago, or within the last month anyway. Well, this is what the yield curve looks like at the bottom of the cycle. When the Fed, you can expect when it starts pumping money into the system the next time, at least as long as the system stays intact. So the exponential nature of the debt to GDP, this is what really I think you need to be aware of. And how soon the system implodes is hard to say. But each financial system, each cycle gets bigger, and the repercussions get more dire. And then the glowing political threats is what I'm really worried about. I think as far as the dollar's survivability as the world's reserve currency, I mean, the media is not going to talk about this stuff. They're much more interested in, you know, the latest sex scandal in America these days. But what's really important, some of these things I think you really need to be aware of. Now, Michael Oliver, I just showed this slide. Most everybody in here probably watches the gold price every day, or close to it. I do, minute by minute almost sometimes. But so I rely on Michael Oliver to a great extent because I've never had a technical analyst that gives me more comfort and a sense of, well, he uses the momentum, things that his own proprietary momentum measures, and I've just found from experience that rather than, you know, run for the hills when the gold price has a big down day, look at the momentum, look at his structure, and it's kept me more sane than I would have otherwise been. Anyway, let's get on to the companies. I'm almost out of time here. Skeena Resources, these are the ones that I've invited to the show, and they're all companies that I have purchased with my own money and on the market, and also, of course, there are recommendations in my newsletter. Skeena, I think, I think all of these are very undervalued at this stage in the market, but Skeena, I have a very high level of confidence in them. They just, I'll let Kelly Earl tell the story. I'm not going to go on too much about it, but their deal just last week of Hochschild, I think, is very encouraging. I don't think the market responded to it and recognizes the value of that to the company, but also I think the Eskay Creek is a story you really want to keep your eyes on. They've had their maiden resource there now, and it's looking very, 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 very promising, I think. And market cap, you know, nobody cares too much about these stocks now. So, Amarillo Gold Corp, the first time here, and this is a company that I was aware of in the last cycle, but it fell upon hard times, and now it's changed management. Mike Muchler will be here in just a couple of minutes to tell you about that. Very advanced stage. They have a pre-feasibility study now that's in place, and just optimized that study compared to an earlier economic study, and it looks to me like the stock is selling at a very small fortune of its NPV. It's 5% discounted NPV. Coral Gold Corp is a name that's been around for a long time, but I knew the company when Louis Wolfen was the chairman and the president, and his son David is here. He'll tell you about Coral, but they're turning it into a royalty company, and they're with the main property, the Robertson property next door to the pipeline and the Cortez deposits, and they have Barrick is now developing that property. It had a resource and a PEA before an economic, a pre-feasibility study, I believe, David, or anyway, it's an advanced property for open pit, but the real target here is the high-grade stuff at depth, and they have had one very high-grade intercept, 5 feet, grading an ounce per ton. So it looks like it has the promise of, I'm sure Barrick must see the potential of this to be another major deposit. David will talk about their strategies. And then New Range Gold Corp, it's a company in the northern end of, its properties in the northern end of Pamlico, the northern end of the Walker Lane Trend. And it's a consolidation of a lot of different small mom and pop mines in the past with, I think, great potential to provide. So it's had some really great high-grade intercepts so far. The company was challenged financially this year, so it wasn't very aggressive in its drill program, but Robert Carrington will tell you about that in a few minutes. Well, that's really all that I have now. I would encourage you to go to listen to my show. You can listen to it live, as I say, at the Voice America Business Channel, or catch the replays the following day, a podcast at J. Taylor Media. Thank you for your attention.